Hello, and welcome back to the channel. I'm Algabot, and this is where we break down automated trading strategies for MetaTrader 5, one expert advisor at a time. Today we're exploring a mean reversion strategy called Recurrence Range Reversion. What makes this one unusual is the engine underneath it, a technique borrowed from nonlinear dynamics called Recurrence Quantification Analysis. By the end of this video, you'll understand how it measures whether a market is truly range-bound, how it fades stretched prices back toward fair value, and how it steps aside the moment that range starts to break. Let's get into it. Let's start with the big picture. Recurrence range reversion is a mean reversion strategy. That means it doesn't chase moves. Instead, it looks for prices that have stretched away from a central value, and it aims to fade them back toward that value. The central value here is simply the average of the last 48 closing prices, which the strategy calls the window mean. Now, mean reversion has a well-known weakness. It works beautifully while a market is oscillating inside a range, and it struggles badly when that range resolves into a trend. So the real question is, how do you know, in advance, whether the market is genuinely range-bound? Most systems answer that with tools like a flat moving average, a low reading on a trend strength gauge, or quiet volatility. This strategy answers it in a more direct way. The engine is Recurrence Quantification Analysis. The idea is to take the recent price path, standardize it so the measurement works across any symbol or time frame, and then map it into a small two-dimensional phase space using a time delay. In plain terms, the strategy asks a simple question: how often does the recent price trajectory come back close to states it has already visited? When a market keeps revisiting the same neighborhood, that produces a high recurrence rate, and the regime is considered stationary and range-bound. When the trajectory keeps drifting away and never returns, the recurrence rate falls, which signals a trend or a breakout is underway. The strategy only fades stretches while that recurrence rate stays above a minimum threshold. Every entry, stop distance, and break-even level is scaled by average true range, so the system adapts to how volatile the market is at the time. The long and short rules are perfect mirrors of each other, and it only holds one fade at a time. It's designed with range-prone currency pairs in mind, such as Euro, US dollar, or Australian dollar, US dollar, on time frames like the 15-minute up to the hourly. Remember, this is an educational walkthrough of how the logic is built, not a recommendation. Let's walk through the mechanics step by step. Once per completed bar, the strategy rebuilds 3 measurements. First, it computes average true range over 14 bars, its volatility yardstick. Second, it takes the last 48 closes and works out their mean and their standard deviation. Third, it standardizes that window into z-scores and maps it into a two-dimensional phase space using an embedding delay of 2 bars, then calculates the recurrence rate, the fraction of all state vector pairs that sit closer together than a small radius of 0.35 in z-score units. That recurrence rate is the gatekeeper. If it sits below the minimum of 0.15, the market is not considered range-bound, and the strategy simply stands aside. No new fades are opened. When the recurrence rate is at or above that threshold, the strategy looks for a stretch. For a long, the just-closed bar must sit below the window mean by at least 1.6 times the average true range, and that same bar must be a bullish reaction candle, meaning it closed higher than it opened. That combination says price has been pushed too far below fair value and is already showing a first flicker of recovery. The entry is placed at the ask. The stop-loss hides one average true range below the reaction bar's low, keeping risk tight and structural. And the take-profit is set exactly at the window mean, the value the recurring regime keeps returning to. The short side is the precise mirror. The closed bar must sit above the mean by 1.6 times average true range, and it must be a bearish reaction candle that closed lower than it opened. The stop hides one average true range above that bar's high, and the take-profit again sits at the window mean. 2 protective layers round it out. Once a trade moves 0.8 times average true range in its favor, the stop is pulled up to the entry price, a break-even lock, so a position that was winning can no longer turn into a loss. And there's a regime guard. If the recurrence rate drops below its threshold while a fade is still open, the strategy closes that position at market immediately. The reasoning is that a collapsing recurrence rate means the range has broken, and it would rather exit before a trend develops than hold a fade against it. It also holds only one fade at a time per symbol. Here's the heart of the expert advisor as it appears in Meta Editor. At the top are the inputs. Recur window of 48 sets how many closes build the phase space and the reversion mean. Embed delay is the 2-bar delay used to shape the state vectors. RecurEps and RecurRateMin define the recurrence radius and the minimum recurrence rate that unlocks trading. Then ATR period and the volatility multiples. StretchAtr for how far price must sit from the mean, stop ATR for the stop distance, and break-even ATR for the break-even lock. Lots and magic finish the list. Now the long block. The condition reads, if the closed bar's close is at or below the window mean minus the stretch distance, and the bar is a bullish reaction, then act. The entry is taken at the ask. The stop loss is the reaction bar's low -1 average true range. The take profit is simply the window mean. As long as the risk is positive and the target sits above the entry, the code calls trade.buy with those stop and target levels attached. The short block is the exact mirror, reached with an else if. If the close is at or above the mean plus the stretch, and the bar is a bearish reaction, it enters at the bid. The stop loss is the reaction bar's high +1 average true range, and the take profit is again the window mean. When the risk is positive and the target sits below the entry, it calls trade.sell. Both sides share the same logic. Fade the stretch, aim for the mean, protect with a structural stop. Let's walk through the chart to see how recurrence range reversion behaves in a range-bound market. Across the lower panel, you can see the recurrence rate, our regime gauge, and it's holding comfortably above the minimum threshold of 0.15, sitting up in the green zone. That tells the strategy the price trajectory keeps returning to familiar territory. In other words, this is a genuine, stationary range, and fading stretches is reasonable here. On the price chart, the solid blue line is the window mean at 1.0850, the fair value the market keeps orbiting. The two gray lines are the stretch bands, sitting 1.6 times the average true range above and below that mean. Look at the opening candle. Price is hovering right on the mean, drifting gently, and the recurrence rate is elevated, a quiet, repeating market. Then a run of bearish candles pushes price lower. By the second candle, it's approaching the lower band, and on the third candle, it has dropped clean through the lower stretch band. Price is now stretched well below fair value. On its own, that's only half the setup. The strategy still waits for a reaction. And on that same third candle, we get exactly that. A bullish reaction candle that closes above where it opened, a first sign that the sellers are losing their grip. With the recurrence rate still parked above its threshold, the long condition is satisfied, and you can see the buy entry marker appear. Notice where the protective stop would sit, just below the reaction candle's low, a distance of 1 times the average true range beneath that fresh low. That keeps the risk on the trade tight and structural. And the take profit isn't reaching for the sky. It's placed right at the window mean at 1.0850. The strategy simply aims to collect the snap back to fair value, which frames a modest, defined reward against that structural risk. Over the next 2 candles, price lifts and recovers steadily. By the 5th candle, it reaches the mean and the take profit is filled. Along the way, if price had first advanced 0.8 times the average true range in our favor, the stop would have been pulled up to the entry price, the break-even lock, so a winning position couldn't have slipped back into a loss. Now watch the mirror image play out. Price keeps climbing past the mean. By the 7th candle, it pushes up through the upper stretch band. Now it's stretched above fair value, the opposite extreme. The 8th candle then prints a bearish reaction, closing below its open, showing the buyers running out of steam. The recurrence rate is still above the gate, so the short condition is met and the sell entry marker appears. This time the stop hides just above the reaction candle's high, again 1 times the average true range away, and the take profit sits back down at the window mean. Price then rolls over, and by the 10th candle it returns to the mean, filling the short's take profit. 2 trades, both fading a stretch back to the same central value the recurring regime keeps revisiting, first from below, then from above. One last thing to notice on the far right. As the final candles form, the recurrence rate begins to slide down toward its threshold. If it had dropped below 0.15 while a fade was still open, the regime guard would step in and close the position at market. because a falling recurrence rate means the range is breaking down and a trend may be beginning. That's the safety valve that keeps a mean reversion trade from standing in front of a developing move. So the full cycle is this: confirm a recurring regime, wait for a stretch and a reaction, fade back to the mean, and stand aside the moment the market stops repeating itself. So there we have it, recurrence range reversion. We covered how it uses recurrence quantification analysis to gauge whether a market is genuinely range-bound, how it fades prices that stretch away from the window mean by a multiple of average true range, and how it aims for the mean while protecting each trade with a structural stop, a break-even lock, and a regime guard that exits when recurrence collapses. Remember, everything in this video is educational information only. It is not financial advice, a recommendation, or a solicitation, and trading always involves risk, including the risk of loss. If you found this breakdown helpful, please like the video, subscribe for more MetaTrader 5 strategy analyses, and leave a comment telling me which strategy to cover next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.